Hi, everybody. This is Luiz Morales with Remax, the real estate company. Welcome back to the Luiz Morales Show. This is episode number 20. Today, we have a very special guest. Her name is Martha Salas. She works with Nations Lending. She's been in the loan business for about 30 years or over 30 years. And today, she's going to be giving us some inside information as to the entire loan process from A to Z. Now, the reason I wanted to do this episode is I feel that a lot of the times the consumers don't know what to expect when reaching out to a loan officer, especially somebody that maybe is new to this entire process, like a first-time home buyer. So I wanted to give somebody just a timeline of what they can expect when purchasing a property. So welcome to the show, Martha. How are you?
I'm doing well. Thank you for having me.
Good.
Congratulations on your 20th video. That's awesome.
Thank you. It's
a service to the community. That's really, really good.
Yeah. Well, I my intention when I started the show, Martha, was just to provide people with information so that they can watch this and then make whatever decision they think is best for them, but just to have free content out there that could really help them. I just noticed none of the lights are on. So, oh, wow. Does that look better?
That's much better.
Oh, wow.
There you
go.
Okay, good.
There you go. Now I look good. Great. So I made a couple of questions for you in regards to what is the first step. So let's say that somebody is interested in purchasing a property or refinancing a property. What is the first step that somebody should do?
Well, the first thing that they should do is there's certain work that they're going to need. Okay. And what they want to do, concentrate on the last 2 years. Want to gather tax return information, documents, check stubs for the last 30 days. If they're self-employed, we want corporate, and they're incorporated, then we want corporate returns. Or if they have partnerships, we want partnership returns. Now, when you first told me about this video, the topic, I got really excited, as I told you, because of one thing. And this is something that most people don't do when they come to see me. And there's been many occasions where we have done this in my office, but I don't do it every time, and that's create a budget. Okay. And 100% of the time that we have done it, clients have been surprised as to how much money they have available to them. They're able to see where their money is going. And it just underscores the reason why they're there. They need a mortgage payment. Okay, they need a place to put their money. And so that's one thing that if I advise clients to take the time, it doesn't take long. They could bring it with them, and we could go over it during the consultation. So they want to gather, going back to the documents that they're going to need. If they own homes, then they want to gather their mortgage statements for each property, leases for each property. But the most important thing really are the tax returns and the check stubs. They also want to get us the last 2 months bank statements.
Okay, so the
loan, yes. Now the loan officer that they're talking to will provide this list, but before they even speak to that loan officer, they'll be ahead of the game and have this paperwork, available to them.
So what I hear you saying is there's some basic documents that are going to be required, but then also if you own a business, there's going to be some additional documents. If you own rental properties, then there's going to be additional documents required as well too. Now, here's one of the things, Martha, that I always encourage people, and I tell them, like, like, even if you're not ready right now to purchase a property, even if you're 6 months, a year and a half out, 2 years out, whatever your time frame is, I encourage them to meet with a loan officer. And what I tell them is that even if you're not ready right now, a loan officer is going to give you a roadmap as to what needs to happen to eventually be able to qualify for a loan. What is your take on that? And can a loan officer take somebody that maybe isn't ready at the moment and give them guidance to eventually get them to the ultimate goal, which is to either buy a property, refinance, or an investment property, or whatever it may be?
Absolutely. There's been times that I have been with clients for the first time, and we discover that they're not ready, but they leave with a roadmap. I'll give you an example of what could happen to a couple that just thinks about it, and they co-signed for, and this has happened, they co-signed for a family member for a car. Okay, now a lender may ignore that payment and not factor it into their debt to income ratio if we can provide, one, the contract that shows that they're both on who's on the contract, and also 12 canceled checks. So I had a couple that came to me, but the person was making their payments cash. Okay, well, when they left, they were so relieved that they had come to my office, and they immediately called the family member and said, stop doing that. Make sure that you're making the payments. Yes, so that, it won't affect them. And they came back, and we were able to qualify them, and it was a significant payment. It doesn't matter if it's $200, or in this case it was $600. It would have really decreased their buying power. So yes, you want to come as soon as possible.
Yeah, and I think it's important, like for me at least, and you know this about me, Martha, whenever I close on a property, one of my next questions is, what do I have to do to get the next one? It always is. And I think that it's something that a lot of people, for some reason, I feel like, not that they're scared of meeting with the loan officer, but they see it as a big commitment to actually meet with a loan officer. And I think that if they actually take the opportunity to meet with somebody like you, they'll actually be surprised. They're like, no, look, you're not that far off. All you have to do is this, provide canceled checks, and now you're ready to purchase a home. So I'm glad that you touched on that. And there's hundreds of examples like that, like
exactly.
Of case by case scenario. So my advice to the consumers is, don't ever take advice, or not don't ever, but be very cautious when a family member or somebody else tells you, oh, you won't qualify because of this, or you won't qualify because of that, because the reality is you won't know until you actually speak with a mortgage professional. So what is covered in the consultation? So it's basically, how do you determine whether somebody qualifies or not? Is it just based on the income that they make? Is it based on debts? How does that take into effect?
Okay. The responsibility of a bank. We have the responsibility to establish job stability, income stability, and that they have the assets for the purchase. Okay, and I'm sure we'll touch on the different types of programs that are available to them. So we have the obligation to do that, and to meet certain guidelines depending on the types of financing. So what we're going to look at is, we're going to make sure that they're making enough, that they meet certain debt to income ratios, and they're different depending on the type of financing, that they have the money. They are able to, if they do not have all the money, they are able to accept gifts. Okay, and at one point in the interview, I would like to talk about things not to do. Okay. Before they come to see me, because we do source where the money came from. Okay, and so we're going to look at their income and their assets and their credit. Of course, we want to make sure that they need at least one FICO score, and they don't have to have an X amount of trade lines. They are able to get a loan with just one trade line, but they do need to have FICO scores. There are even financing available when you don't have FICO scores, but the rates are higher and it's more difficult to qualify. So those are the areas that we look at.
Now, the cool thing about maybe somebody that doesn't have the FICO scores, or maybe somebody that purchases things in cash, is there's ways to establish those sorts of things. And obviously, you can help guide them if obviously they just come in for a consultation, right?
Yes, and in fact, that's another reason to come, to prepare for home ownership because they may not be ready. They may not be where they like it to be, but they walk away with a recipe. They actually know what steps to take to bring up their FICO score.
Let me ask you this, because I hear this all the time. I just bought a car because my
Yeah.
friend told me that the way to establish my credit is by buying a car. Will that help? Because let's say that they want to buy a house, but they buy the car first to establish their credit. Is it necessary to buy a car, or are there other ways to establish your credit versus buying a car? Because I mean, that just sounds like a big commitment to me, to be honest.
Well, why don't we just go to what things not to do
That
before they come to
so
see a loan officer?
hard.
Do not make major purchases. Do not co-sign
Uh,
for major purchases. Do not deposit cash.
so
Okay.
I feel like a lot of people self diagnose themselves. Like they're like, oh,
That
well, I'm gonna go buy a car to get my credit up instead of talking to the loan officer, and the loan officer saying, no, that's gonna affect your purchasing power for the next 5 years because that's how long your car payment is. Instead, do this.
Right. There's been many times where I will talk to a potential client, and they will, oh no, wait, I'm working on my credit. I want to pay off some bills, and I tell them, do not pay anything until you come to see me, because we'll have simulators where we can advise how what to pay, what's going to give them, the better results in their FICO scores. So paying off that old medical bill, people want to pay these old medical collection accounts first, and many times even their FICO score will go down, so they want to see their loan officer first.
So for those people that didn't understand what you said, it's a simulator essentially where they take a look at your credit and they say, if you pay this off by this amount, your credit goes up by this. If you pay off
Right.
this by this amount, your credit goes up to that. And then essentially you can play with it and say, okay, pay this down by that much, that down by this much, and pay this off completely. And your credit should go up to approximately 720 or so. And that's the benefit of having somebody with this type of software, that they can actually guide you through this, as opposed to self-diagnosing yourself and thinking, well, I'm just going to pay this off, where maybe instead of helping you, that may affect you, right?
Right.
So I think the main thing is just getting the guidance from somebody. Now, what is the difference between a pre-qualification, Martha, and a pre-approval?
A pre-qualification is where your loan officer uh, reviews all your documents and the credit, and makes a decision that you meet the guidelines for the loan that you are applying for. A pre-approval is a process where your application and documents are actually submitted to an underwriter, and you actually are approved by him or her, and before you start shopping for a house. Most lenders, most of us are very mindful of not clogging up our pipeline with too many pre-approvals.
So essentially, a consumer has both options. A consumer can get pre-qualified. Essentially, they can start shopping for a property because it means that the loan officer has reviewed the basic information. Or you can go through the entire pre-approval process, which means the underwriter has actually reviewed it. But it's more common just because of the workload that the underwriter has to just do the pre-qual, and once they identify the property, to go through the whole entire pre-approval process at that point.
Yes, and there's many safety nets that a loan officer can take if there is something that's borderline, then the loan officer will submit the loan to an underwriter. Okay, we can actually, if there is something, a situation because of a job history or something that's just a little does not meet the guidelines exactly. Okay, the loan officer will run this information by an underwriter and have it in writing where they are agreeable to to the buyer getting a loan based on that criteria. That can be done. Running an electronic approval. There's a lot of things that can be done ahead of time, and I certainly try to do it in every pre-qualification that I take.
Not only that, but I think the benefit of having somebody that's been in the business for a long time, and somebody that has been through hundreds and maybe thousands of different scenarios is the fact that they may be able to see problems before they happen, and may already even have some solutions to those problems. Like if somebody has a 30-year or a late on their mortgage payment, or different ways of structuring the loan can essentially be the difference between being pre-qualified or pre-approved or not.
Of course.
What's the major difference between like a big bank and, like, let's say a broker? What's some of the differences there, like between maybe working with like the bigger banks, I'm not going to mention any names, or maybe a smaller brokerage?
Okay. A major bank only sells their product. Okay. They process, approve, and service that loan. A mortgage broker does not, they do not approve the loan. They will shop with different institutions, send the loan for approval elsewhere. Okay. A mortgage lender can process the loan, approve the loan, and fund the loan, and at times service the loan. They're delegated to shop to fund the loan, to approve the loan for different investors.
The way that it was explained to me a long time ago is that sometimes working with a mortgage broker is like having different options for the consumer. And then if they don't fit in this box, you may be able to fit them in that box. And if they don't fit in that box, you may have them fit in that box. And sometimes by working with the big banks, there's one option now. So it's just different options. My recommendation is talk to both. Get an opinion from both people. Talk to the big bank, see what they can offer you. Talk to the smaller bank. Now, has there ever been a time, Martha, where maybe a customer has gone rejected by maybe a big bank and a smaller broker can actually do the loan because they have more products?
Yes, it happens a lot because a bigger bank has their product. Okay, a mortgage banker, for example, has different investors, and they don't have to send out that loan to the investor. They have control. Okay, so they're shopping for the client, but they have more control, and it's as an example that happened, I think with one of your transactions. You may not remember, but they were it was a doctor was denied by a major bank, because of lack of credit. Okay, even though the FICO score was too high, and a bank can do that. They have the luxury to decide the level of risk that they're going to take. And with us, we didn't have a problem. The interesting thing is that we sold it to that same bank.
On the back.
Yes, and that was perfectly fine with their guidelines.
Well, I can think of a different situation where I think they owned a rental property that was paid off free and clear. She was a hairstylist or something like that. And I remember her reaching out to me and saying, I want to purchase a home. And she said, I went to a big bank and they denied the loan. Is there anything that you can do? And I referred them to you. And I said, hey, look, if somebody can do the loan, Martha could do it. And you took a look at the situation and you said, no, if we structure it this way, and this way, now this same person actually qualifies. So my advice to the consumer is don't take no for an answer. Get a couple of different opinions, but be careful with that, because there's a lot of people that will actually tell you that they can do it and they will. And when it comes time, they overpromised and didn't deliver. So be careful who you get that opinion from. Make sure that you get it from somebody that's reputable. Make sure that you get it from somebody that has been in the business for a long time and really understands the guidelines and why they're telling you that they can do it versus the other person actually makes sense. So I would recommend that if you've been denied for a loan, give us a call. Ask us like, hey, look, get a second opinion. Is there anything that you guys can do differently? And give us the opportunity to do that. And at least this way, I know that if our team can't do it, then it's very likely that maybe nobody can. Or if we can't do it and we know somebody who can, we'll guide you in the right direction. I mean, we'll tell you, hey, look, such and such person can actually help you with this better than we could. So we're not interested in just serving. We're interested in guiding people in the right direction. That's what we're interested in. How far in advance, Martha, can somebody meet with a loan officer prior to purchasing a property? Is there a limit on that?
How far in advance? Say that again. I didn't understand.
How far in advance can somebody meet with a loan officer? Like let's say that their goal is to buy a house in 3 years. Can they meet with a loan officer now?
Absolutely.
Yeah.
Well, now here's the thing. If a client has the desire to purchase a house, okay, that alone should be a clue, the cue that they should come and meet with a loan officer. And even if it's 3 years down the line, they will know what to do. Now, it's scary for people, the thought of home ownership. And it is a major decision, but not buying, I think, is a even bigger decision, not doing anything. And so making an informed decision to buy or not to buy should be their goal. At least they are making the decision, but it's an informed decision. And yes, as soon as possible with that desire. That's all they need.
Here's what I tell people. Sometimes I hear right now people say prices are too high or the market is too high. What I tell people is just meet with a lender, get pre-qualified. There's good deals in every marketplace. I mean, we just listed a property at $389. We have another one in North Oxnard at $415. So good deals come up. Just meet with a loan officer first, get pre-qualified, and then just patiently shop for a property. Take your time if you need be, and wait for a good opportunity. How long is a pre-qualification or a pre-approval good for? So let's say that they meet with you, they bring you all the documents. How long would that pre-approval be good for?
Well, the credit report is good. A Fannie Mae guideline, to quote you, is 120 days from the date of the note. So the loan officer will gauge and make sure that the client is updated if they're still, while they're still shopping, to make sure that they're no, there's no surprises, that nothing has changed.
Okay.
So you want to stay within 30 to 120 days. Your loan officer will make sure that that's updated,
That's
and you do not let it expire more than 90 days.
perfect. Okay, good. What is the max number of people that can actually be on the loan? And then what is the lowest down payment that you've ever seen from a consumer that the lowest amount that they've ever had to come in?
Yeah, I have seen certain lenders that will have an overlay on the amount of buyers that one could have, but there isn't. I still remember my waiters that bought together. They all got together and they purchased a
Wait,
house.
on a property? How many of them were there?
There were 5 waiters.
Wow.
Yeah. You know, they talked about home ownership at work, and then finally went, okay, well, let's just stop talking about it and do it. And they did.
That's cool. The most I've seen is 3, and in fact, I think on one of my listings, there's 3 family members that are going on a loan right now, and together they're buying their first property. What is the lowest down payment that you've ever seen on a property?
$0.
$0
down. Yes.
What-
There's lots of programs out there for every type of borrower.
Is that for a VA or is that a non-military person?
It's for military. Is 0.
0% down.
Then you have your down payment assistance
Let me ask,
programs out.
for a non-military person, was it still 0 the lowest down payment you've ever seen? $0?
Yes.
Yeah. Wow. Okay. Cool. Yeah, I remember doing one with you that was $2,000, and I remember thinking, like, if they were gonna rent a property, they were probably gonna have to pay first month's and last month's, which they're probably looking at about $6,000, and they ended up coming in with $2,000 total.
Right.
That was like mind blowing to me, because a lot of the times I would hear people were saying, like, well, I don't have enough money for a down payment. I don't have enough this, or I don't have enough reserves. And that's why I tell people, meet with a loan officer. They'll provide you with options. There's different options out there, and you won't know until you actually meet with somebody. Also, I know that there's a lot of people watching, or a certain amount of people watching right now. So if you have any questions, we're monitoring them. Andrew Kunisawa, Martha, he said hello. He said, Martha is a pro and will work hard for you. He's always value. Ernesto, Richard Dugal, thank you. Appreciate that. I did want to ask you, is there any rule of thumb, Martha, as to how much somebody would actually qualify for? Like, let's say that they make $5,000 a month. Is there like a rule of thumb? Like, okay, if you make $5,000 a month, you should qualify for 50% of that for a mortgage payment of $2,500. Are there any rules like that assuming that they have no debt, that somebody would kind of know? And this is kind of just on the spot.
Yeah. See, there's a day to that.
Uh-huh.
Putting that out there, because people will disqualify themselves. They will. And because it would be additional income there that I could use, there a way of ignoring certain or excluding them from their debt to income ratio. Okay, so we have, for example, I could give you the debt to income ratio that FHA will go up to. For example, it's 56.9. Okay,
what does that mean?
That means that their monthly payment and their credit liabilities can go up to 56.9% of their income.
So meaning that, like, if they make $10,000, their entire liabilities on a month-to-month basis can go roughly about $5,600. They can afford not a $5,600 payment, but essentially their monthly liability, like car payments, credit cards, mortgage, taxes, insurance, can go up to that amount.
Right. But what I don't want the buyer, potential buyers to do is to qualify themselves,
And
pre-qualify themselves.
that's what I don't want either, because a lot of people do that. Here's another thing that I did when I graduated from college. So a lot of people think that they need to be in a job for 2 years. And
Right.
when I graduated from college, I met with a loan officer right before I did, like maybe like a year or 6 months before. So look, I want to buy a gold. I hear you have to wait 2 years to get qualified. And I said, wait, are you in university? I said, yes, great. What are you getting your degree in? Great. Just get a job in the same line that you're graduating in, and you can buy right away. I forgot what the waiting time period was, but I bought my house, I think, within 6 months of graduating from college. So here's another thing where people, I spoke with somebody a couple of weeks ago, and they were like, well, I'm going to graduate from college. I have to wait 2 years. I'm like, no, you can actually qualify potentially now. You should get with the loan officer now and ask what options do I have, because that was a big aha, and that allowed me to purchase a great property at that time. You know, it was 2010, and thanks to meeting with somebody at that time, that opened up my eyes as to what was possible. So let's talk about now. We've talked about enough about getting qualified and getting ready and the benefits of doing that now. Once an offer, so just so the consumers understand, once you get pre-qualified, then you start working with a real estate agent. They start shopping homes with you, and then eventually you make an offer on a home. The seller accepts your offer. You've got a fully executed contract. You're about to open up escrow. What is the next step, at least from a loan perspective, once that happens, once their offer gets accepted on the home that they want?
Okay. The loan officer will review the documents to make sure that there's nothing missing. Okay. And what the loan officer wants to make sure is that we have the income documents in place, we have the assets identified, their gifts, so their money there's money in the bank. So that's in order. The loan officer will now submit the loan application with the contract, and put the loan in process. The first thing that's done to that loan is the initial disclosures are prepared. These are documents where an estimate is provided to the borrower along with government disclosures. Okay, these are documents that the borrower has to sign and should sign as soon as possible.
Mm-hmm.
The appraisal, then the next important thing is the appraisal is ordered and the employment verifications are ordered. One thing that our company does is we will even order the employment verifications while we're pre-qualifying a buyer, so that when we get to that point, we have employment verifications back. There's also other processes that take place. We verify that their Social Security belongs to them. So there's other processes that we have to, by law, adhere to. Okay, and go ahead.
Go. Sorry.
Okay. Once the employment verifications are in, the processor will review and make sure that the debt to income ratios are in order, that everything that we need to submit the loan for approval is in the file. And the appraisal in our company doesn't have to be in at that time. We can submit the loan for conditional approval without the appraisal. Okay? And these are the important milestones that we look for. The appraisal is ordered and received. And the next important milestone is the receipt of conditional approval.
Conditional approval. So essentially, from the point, are they the same documents during the pre-qual for once your offer gets accepted, just updated the same documents, or are they the same documents updated and just a few additional documents, or is it mainly just signing a few disclosures now at this point?
That's a very good question. For you have so when we collect income documents during the pre-qualification process, you're going to have W-2s and check stubs, right? Well, then what we're supposed to do is we're supposed to um, as backup, make sure that the income is in line. And so we actually get an employment verification directly from the employer that is going to provide us not only it's information but more in detail.
Okay.
We're just backing up those documents that they're accurate.
They had already. Okay.
Right.
And I actually forgot this question, but from the point that they're shopping for a property to the point that they get their offer accepted, what is the interaction between the loan officer and the client? Is it something that they're just communicating with the realtor, or are they going back and forth with the lender and talking about different situations?
When they're while they're shopping,
Huh?
that's a very important time, actually. When they leave the office, the borrower knows what his buying power is and what type of financing they're going to get. So, what I asked the borrower now you're going to compare homes. You also want to compare numbers for each home so that then you're able to to decide that maybe that home that's a little bit more, but the value of having an extra bedroom, because a bar, when they're in my office, we're just looking at numbers. So all numbers that are lower, that's what's important, right?
Really?
But when they actually go out, they're able to see the actual value of that number, better neighborhood, and so I like to give my borrower their numbers in writing, so they're able. So we have a history of them, and they would go back and we could discuss. So there's a lot of interaction between a loan officer and the borrower while they're shopping for that house.
And it's come to my attention that sometimes the borrower in the pre-qualification will say, "Don't give me any payments above 500,000. I don't even want to go there." And then they actually see a property that they really like at 500,000. So at that point, they come back to the loan officer and say, "Okay, great. What would my payment be?" Not only that, it's really important to be communicating with your loan officer while you're shopping for properties, because sometimes interest rates change. I've had situations where the
Yeah.
interest rate drops a little bit, and now you can afford a little bit more for the same monthly payment. So it's really important to have communication. And what's really important is to work with a loan officer who's available as well too, because sometimes, yeah, I mean, you're seeing a property on a Sunday night at 5 o'clock, and you like it, and you need to get payment information, and your loan officer is in Hawaii or Cancun, unavailable, or something. And everybody takes vacations, but you want to make sure that your loan officer is available in most cases to be able to give you these types of scenarios, because sometimes the property that you may like, the seller's making a decision Monday at 8 in the morning, and you need the information on a Sunday afternoon. You have to make sure that your partner, your loan officer, is actually there to be able to provide you with this information. That's oftentimes overlooked, but it's something that is really, really important, not only for the real estate agent to work with a loan officer who's available, but also for the consumer as well too, right?
Yes, in fact, the attitude is that once a property is identified, that is considered an emergency. We have to prepare that borrower to be able to compete. And the only way that that borrower is going to be able to compete is to provide that information. And so that call on Sunday at 8 o'clock, it's crucial. Come, they have to go to sleep knowing if they're going to compete, how they're going to compete. So it's very important to make sure that uh, that you are in fact your client's partner in that process.
And not only that, but there's certain things that sometimes, like as a listing agent, sometimes we counter out. Like we just had a situation where we had 10 offers on a property and we countered back everybody, no loan inspection. And I mean, your loan officer has to feel certain in your file that it's pretty much an A+ file and that it's going to close 100% in order to remove certain contingencies like that. So not only is it important to have communication with them when you're getting counters back and forth with different terms from a listing agent or a seller, but it's also important to have somebody that is certain on what they're doing and that can say, you know what, I've been through enough of these situations. I'm 100% confident that this is going to get done. I mean, there's no reason why this wouldn't get done. I've had situations where some loan officers are like, well, I don't feel comfortable, or maybe somebody's a little bit newer and doesn't have that experience to be able to say with certainty, like, this is going to happen. Let's do it. We're all on board and we're going to make this happen. So
I just got a call from someone in your office regarding that very question. And the way that I handled it was, yes, I feel comfortable. And then I listed all the reasons why I felt very comfortable moving forward.
And that's sometimes what you need, because I mean, sometimes you receive these counters back from listing agents or sellers that when you're in a competitive marketplace like the one that we're in right now, they want certain contingencies removed, they want appraisals removed, they want inspections removed. So you need a team that has been in these types of situations and that knows that they can perform under the pressure, because if there's 10 offers on the table, there's only going to be one person that gets that property. There's only going to be one family that is that family that gets their offer accepted. And sometimes you have to do certain things to be that family that gets their offer accepted. So now that we have submitted all the documents and we have conditional loan approval, what is conditional loan approval? What does that actually mean to people? And what are some of the conditions that could come up?
In all the years, I've never had a loan approved that did not have conditions. Not one. Okay. So some borrowers feel disappointed that there's conditions, right? And it's something to expect. Every conditional approval is going to have conditions. Okay. There's your standard housekeeping conditions from that's on every single loan. It's an example. Fine, that's something to expect, right? And there's other things that may come up. We admit, and we have this contingency period to adhere to, right? And there's documents that we're waiting for. We will make a decision to submit that loan without them, okay? Because it's not going to have a bearing on the approval. So we hold up a file as an example. More current bank statement to the current because the deposit was made, or we have to source all large deposits. Okay, and let's say that a borrower has not submitted a copy of the canceled checks for the deposits. That's very common. Okay, to have conditions that perhaps are documents that are forthcoming but are not in the file yet.
Yeah. So essentially, in other words, a conditional loan approval is saying your loan is approved based on these conditions. So if you're the real estate agent or if you're the loan officer, I would take a look at those conditions. Like one of the things that we do for our team is when they say, okay, your loan is approved based on these conditions, we take a look at the conditions and we reach out to the loan officer. Great. Or is there any condition on this list that you may not be able to meet as the loan officer? Because sometimes you'll get some conditions that are like, oh my God, like the underwriter is asking me for this. And you have to be certain that the conditions are pretty straightforward and easily attained. Like, I'll give you guys an example of a condition that I've gone when I get loan approval. So they'll say, Jose Luis, your loan is approved based on this condition. There is a child support lien that came up in Missouri, and you have to provide proof that that is not you. Apparently, there's another Jose Luis Morales in Missouri that has a child out there that's not paying his child support, and my loan officer needs proof that that is not me. Now, I know for a fact 100% that I don't have a son in Missouri, so it's easy for me to say, okay, that's a condition that that is not an issue, and I can get proof of that, But sometimes you'll get like conditions like provide proof that your divorce has gone through, and maybe it's not there yet. Or so it's important when you receive conditional approval that you take a look at those conditions and you make sure that before removing your loan contingency that it's something that is pretty straightforward and it's going to be able to meet. A lot of those conditions are just provide proof of this, provide copies of these large deposits, provide proof that this is not you, provide proof that this whatever it is, that this income or whatever. But they are a list of conditions. But by that point, it's just, okay, you provide those conditions and the loan is good. What happens after conditions are submitted? So we get these list of conditions. We submit the conditions back to the loan officer. What is the next step after that?
Okay. Next step is to submit the loan for final. Okay. This is where you will get a where the underwriter will review all these conditions and provide you with the green light to draw the loan documents. The file goes to the underwriter. The underwriter reviews conditions. Once the underwriter feels comfortable that everything's in line, they go to a department that's quality control. That is a 2-hour process, 3-hour process at most, where they just do a once over, make sure that nothing was missed. Okay, they may even verify employment, do a self poll, and that sometimes can be waived on certain situations, special situations. And then once it's out of QC, then it goes to the document department and they draw the loan documents, the final documents that the borrowers are going to sign.
Okay. Well, one of the things that came up for me in what you just said about going back to the underwriter is as a borrower, you want to make sure that you're working with a company that has pretty easy access to their underwriter and that has pretty easy communication. Because sometimes when a company not is too big, but there's too many different departments or too many different layers, there's some loan officers that don't communicate or can't communicate directly with their underwriter, that they have to communicate with the manager, then the manager, then the manager, then the manager, then the underwriter. So it's really hard to make decisions sometimes decisions in real estate need to be made fairly quickly. And there's a lot of pressure to get something done. So the easier it is, or the better relationship the loan officer has with the underwriter or the company has with their underwriter, the easier the loan process is going to be for you. I can't tell you how many times we've been in transactions where maybe that is not the case, and it leads to a lot of pressure for the borrowers because there's a lot of unknowns at that time and a lot of delays sometimes where it's something that could be 2 hours takes 2 days,
I can't underscore that enough. Having worked with big bank and you have and your mortgage broker, and now my after very many experiences, for me a mortgage banker is more to my liking, but that very is what makes a lending institution a company that looks at the client as a human being and is able to respond to the needs of that transaction as if it were their own. And you need to have that kind of communication with different layers of management when it's necessary to make sure that that transaction is successfully closed. I could not work for a company where I could not appeal, where I could not get an instant response. I just need to work with a company that provides that kind of service to the client. And it's so important.
And I can't stress this enough because I was looking at my transactions. We've done over 400 deals in our career so far. And I've been through everything, or not everything, but a large percentage of the things. We've had situations where some borrowers, maybe there's another loan officer representing them. The loan officer says everything is good, everything is good. All of a sudden, the buyer doesn't qualify. The lender's not responding. The underwriter's not communicating. One of the biggest decisions that you as a borrower are going to make is who is your loan officer, and then who is your real estate professional. And the easiest thing to do is to go with somebody that you know already, but sometimes that is not the best thing to do. And I'm saying this just from the bottom of my heart. It is not the best thing to do. My recommendation is talk to a couple of different people, get a couple of different opinions, work with people that have been through war already and are just coming back and know what that is versus maybe somebody that's barely going out there. So it's really important decision to make sure that you're working with somebody that is going to respond. I've had situations where I'm the listing agent and there's buyers representing their buyers or buyers agents representing their buyers. And the list, I've gone the earnest money released already. The earnest money's in the seller's pocket and they're unable to perform. And then finally they perform. And it's so much stress for that borrower. I've had situations as a listing agent where we've had to keep the earnest money deposit because the lender is saying, yes, they're going to perform. Yes, they're going to perform. And for whatever reason, they're unable to perform. Yes, we have kept earnest money deposits to represent our seller's best interest. Not something that we like to do, but as a listing agent, that's my job to look out for our seller's best interest. So you want to make sure that if your lender is saying, yes, this is going to happen, that you have somebody that has been through these types of situations before. Otherwise, your earnest money, your $5,000, $10,000 could be at risk. In that case, it was $5,000 that our seller kept. $5,000 gone.
The advice that I give loan officers, okay, experience, of course, helps a lot. Because then you're able to have something that I didn't have when I first started, and that is the confidence of that intuition, okay? That instinct that you listen to. And it happened, I'll give you an example of something that happened recently where we verified something and it was something that we wanted to hear. It was positive news, but my instinct told me to double check. And the borrower asked me why. Why are we double checking? I said, because I think we should. We should just make sure. And we were both on the line verifying this information and was able to probe that person to make sure that they were doing their job. But something just told me that we should double check. And that's just comes from experience because the risk was too high in that instance, and it just something that would take 24 hours to double check, and sure enough, when we double checked, it was that person was not doing their job. So I say tell the loan officers, listen to your instinct and just double check. And take a minute to just make sure that if the income is a little bit unclear, then what the service of providing that, ordering the employment verifications while you're being pre-qualified really helps make sure that there are no surprises later.
But what I like about working with you when we work transactions is that you understand your guidelines. Like you understand like underwriter guidelines and how they look at things. And sometimes I'll call you with a question. You said, let me check the guidelines. Let me check the underwriter guidelines. And then you'll say, well, the guideline says this, this, and this. It doesn't say this. Let me run it by my underwriter to see if this, and this would work. And I'm like, okay, great. And that's the thing that you get when working with somebody that understands guidelines as well too, is that they can take a certain situation and say, well, this is the guideline. If we structure it like this, then we fit in that guideline. Let me ask you this, Martha. Why do people qualify for a loan or get pre-qualified and then not be able to close? Like, what happens in those situations? Who drops the ball there, or what? I know there's times where finances change or the borrower goes off and does something that he shouldn't do, but why does that happen?
What I have seen is there's information that is held, okay? And borrowers just provide your loan officer with as much information as possible. Do not withhold information, because you are not allowing the loan officer to go to bat for you, because guidelines are their framework, right? Guidelines, how we work within those guidelines is important. The more information we have, the better we to be able to use those guidelines to the benefit of ours. So yes, surprise do have a lot, and if the loan officer is straight on the income, then I suggest ordering an employment verification as soon as possible, so that you know from the bare upfront what income is going to be used. Do not take any chances.
The other thing I was going to say is that a loan officer can and I blanked out. I was headed somewhere, but yeah, live Facebook. Great. We went over the loan documents. Great. So after funding, or after they receive final loan approval, after they sign loan documents, what is the loan documents? What is included in those loan documents, Martha? That people
the most important document that's in the loan documents, a note, which tells you, you owe an amount of money. This is going to interest rate on that loan amount, and the period, the term, the period of time that you get to pay back that principal balance. That's the most important document. And then there's a lot of other, pretty much a of your initial documents, or your federal disclosures are in there, and state disclosures are in there as well. And then, of course, more importantly, is your document. It will tell you exactly what the interest that you're paying, and how everyone gets paid. Who its closing costs are, your down payment, your the closing costs, and who's getting what, and how much money you need to come in with to be able to close.
Essentially, what I realize is the most important thing is review your terms, how much money you're bringing in, what is your interest rate? Is it a fixed loan? Is it a 30-year fixed loan? Is it a 15-year? Is it an adjustable rate? So I think this is one of the most important documents, because this is, once you sign this and once the loan gets done, I mean, those are the terms of your loan. Like, I know back in 2005, 2006, 2007, 2008, there was a lot of fraud, and there was a lot of people that were being told that they were on fixed rates or 30-year fixed rates, and there was adjustable arms. So this is where you can find out all of that. And if something is different than what your loan officer has explained to you, if you are under the assumption that you're on a 30-year fixed and you see on there that it's a 5-year loan or a 5-year arm, don't sign it. Don't sign it. Contact your loan officer and say, hey, I think there's a mistake on here. We had talked about a 30-year fixed at this rate. What is going on?
That's right.
Explain it to you, because then don't take the, oh, something will change or there'll be something different. Or no, do not sign it. These are the final loan documents, right? Is that pretty accurate to say on that? Like, if somebody
absolutely.
Don't sign it.
Yeah.
If somebody's telling you one thing, and then it doesn't matter what they're telling you, it matters what's in writing.
Right.
That's the important part. So that's my advice from a owner, investor, real estate agent, whatever it is. Great. And then the bank funds, it records. So once you sign the loan documents, it funds, meaning the bank releases the money, then it closes escrow, it records with the county. Once it records is when you're officially the new owner of that property. So essentially, in a nutshell, that's the loan process from start to end of everything that kind of goes wrong, or everything that kind of goes on. There's a lot of things that could go wrong in a transaction. You just want to make sure that you're working with people that know what they're doing. Advice from lenders, Martha. What should people not do during the loan process? What should they not do? Are there certain things that are no-nos during this process?
Yes. You should communicate with your loan officer regarding all major decisions. For example, if you have gotten this great offer for a job change, okay, call your loan officer immediately. Most likely it's going to be fine if you just want to make sure that he will ask you all the important questions. Is it a permanent position? Someone, for example, as an example of a no-no. Okay, someone got a great offer by this agency and was leaving a permanent position and moving over to an agency. And with an agency, we need them to be there 2 years. It would have destroyed the loan had he quit. And so you want to just run everything by your loan officer. Do not make any major decisions. Do not deposit cash. Make all your payments on time. Those are some of the things that you want to do during the process.
What I would say as a rule of thumb, anything that has to do with money or finances, check with your loan officer first.
Yes.
I remember when I was buying a car, I called you and I said, look, Martha, my goal is to buy a property. And this is a car that I'm looking at. This is the monthly payment. And we decided to hold off at that time because it would have affected my ability to purchase what I wanted to purchase. And I had to make a decision of what was more important to me at that time in my life. So it's important that you check with your loan officer anytime. Before it closes, anything that you do will affect you. Meaning,
yes,
I've heard of stories, luckily it's never happened to me, of somebody that signs loan documents or something, and then they go off and buy a car, or they go out and buy new appliances for the home. They go out and buy furniture. And I mean, that affects you.
We could do a soft pull, right at the very end. And if we see a major purchase, it could uh,
Could affect
keep
it.
you from buying the home. So just staying in open communication with your loan officer and your realtor during this time is just really really important. And there's one thing that I noticed in the last 2 years. There are people that are very conservative and they don't use their credit a lot, right? And two people in the same year where they were shopping for the house and they did not use their credit. Everything was zero, and all of a sudden their FICO scores disappeared. Okay, so if you're one of those people that do not use your credit, try to maybe use one of your credit cards for gas and pay it off each month. So you can go have two extremes. You could have the extreme of someone that maybe uses their, you have too much debt. That's one extreme. But you could also have on the other side of the spectrum, someone that is not using their credit at all, and that you don't have FICO scores, which would be a bad thing.
Perfect. Great. So I think that's a lot of information for the consumers, Martha. I've really enjoyed having you on this call. I want to say thank you for providing all of this information to the consumers out there. I think that if somebody watches this episode, there's a lot of information on what to do, what not to do, what is recommended versus what is not recommended. And if you guys ever have any questions, Martha, where can people get a hold of you?
You can call me on my cell, 805-890-2008.
Perfect. All right. This is Jose Luis Morales. This is the Jose Luis Morales Show. This is episode number 20. If you ever have any questions, you can reach me at 805-228-4672. And we look forward to being your real estate agent and just helping people make the right decisions when buying or selling real estate. And we're happy to answer any questions that you guys may have in the future. Thank you so much. Make it a great day. And
bye, Jose Luis. Thank you for doing this. It's really good.